Are you a real estate investor? Have you ever wondered if you could write off the purchase price of your rental properties against your rental income? I mean, after all, the purchase price of your rental properties are the biggest expense when it comes down to real estate investing. Did you know that CCA allows you to claim the wear and tear of the building against your net income as a deduction called Capital Cost Allowance, also known as CCA? But there are special income tax rules about claiming CCA against your income in Canada. Capital Cost Allowance is more like a tax deferral, not a deduction. This means that you have to pay tax on the income when you eventually sell the rental property. Since you have to pay tax someday, have you wondered if it is worth it to claim CCA against your net rental income? If you are real estate investors and want to maximize your tax deduction, if you are paying a lot of taxes on your rental income and wonder if claiming CCA can help you reduce taxes, you've come to the right place. Today, we're going to discuss everything you need to know about capital cost allowance deduction, the tax rules around claiming CCA, and 3 criteria to help you determine whether you should claim it or not. Before I dive deep into the discussion, make sure you subscribe to our YouTube channel to stay on top of the latest Canadian tax tips. If you like our videos, make sure you give us a thumbs up and comment below. If you have questions, feel free to ask them in the comment section below, and I will sure to get back to you. So let's get started. We're going to talk about everything related to claiming Capital Cost Allowance, CCA, as well as the criteria to determine whether you should claim it or not. What is CCA Capital Cost Allowance anyway? When we invest in real estate, the biggest expense is the purchase price of the property. If you get to claim a portion of the purchase price of the property against your net rental income, you could potentially save a bunch of money. Thankfully, CCA recognized that you could incur this wear and tear on the property when you rent out your investment property. As a result, CCA allows us as real estate investors to claim the wear and tear on the property, and this wear and tear deduction is called CCA, Capital Cost Allowance. CCA allows us to claim 4% of the undepreciated capital cost of the building against our net rental income. Now, if you purchase a property for $500,000, the maximum available capital cost allowance you can claim is $500,000 multiplied by 4%, which is $20,000. Capital Cost Allowance is a tax deferral you can claim over a number of years against your net rental income. It isn't a straight-up deduction. If you're familiar with the concept of RSP contribution, Capital Cost Allowance is kind of like RSP contribution. With RSP contribution, the year that you make RSP contribution, you don't have to pay the tax on the amount of contribution that you make. Similarly with CCA, the year that you claim CCA against your net rental income, you don't pay tax on the amount you claimed. The year you sell the rental property, that's the year you will take all the CCA that you claim over the years as rental income. The amount you have to take back into income is called recapture. Let's use an example to illustrate. If you purchase a property for $500,000, inclusive of closing costs, you claim CCA in year 1 for $10,000, you claim CCA in year 2 for $7,000, and then you claim CCA in year 3 for $3,000, and you sold the property in year 4 for $650,000. Of course, you have to pay tax on the capital appreciation of the property that you made on the sale of the property. This is calculated by taking $650,000 minus $500,000. The net delta of $150,000 is taxed as capital gain, and 50% of that you have to pay tax on, which is $75,000. But capital gain tax is just part of the equation. Because you claim CCA in year 1, year 2, and year 3 for a total of $20,000, you have now to report that $20,000 as recapture income in year 4. So on top of the $75,000 taxable capital gain, you have to add in the recapture income of $20,000, increasing your taxable amount in year 4 to a total of $95,000 on the sale of the rental property. Clearly, Capital Cost Allowance is a tax deferral. You defer the taxes to be paid in the year of sale. Keeping more cash in your pocket now is the key. Then how do you determine if you should claim Capital Cost Allowance or not? I have 3 criteria to help clients decide if they should claim Capital Cost Allowance. The number one criteria is how much money are you reporting in your personal tax return first. If you are making more than $100,000 before you earn your rental income, you have to pay about 43% marginal tax rate or more on any additional rental income that you earned. If you claim CCA, you save 43% tax on your net rental income. If you expect to maintain the same level of income in the future when you sell the property, chances are you will be paying the same 43% on the tax when you sell the property. So you are choosing between paying the tax today versus paying the tax later. For sure, if you're making $100,000 or more from your regular salary, I would claim capital cost allowance. The reason is because the money that's in your pocket today is worth way more than the money in your same pocket when you sell the properties 10 years down the road. By deferring the taxes to future years, you're essentially saving the time value of money. Now, the number two question that you would ask is whether you need the money now. The reality is, it really comes down to your need. Maybe you just don't want to pay the tax now. Maybe you're reporting very little income. Maybe you just reinvested all your cash flow into a different project and has no cash. Realistically, if you just don't want to pay now, capital cost allowance gives you the flexibility not to pay in current year. Now, the number three criteria to decide whether you should claim CCA or not is a lesser known criteria. It is more about your plan with the property, your future plan. Sometimes real estate investors may choose to move into the rental property sometime down the road. If you claim CCA against the rental property in the past, CRA would deem to have your property disposed at fair market value when you move in. You have to pay capital gain tax and recapture tax even though you never sell the property to a third party. If you know or have a chance to move into a rental property, do not claim capital cost allowance. If you don't claim CCA and move into the rental, you can choose to defer the capital gain to the year you sell the property to the third party, when you actually truly sell the property and pocket the cash. Thank you so much for watching. Capital cost allowance is a complicated concept. If you have any questions, make sure you ask them in the comment section below, and I will personally get back to you. If you like what you have seen, make sure you like the video and subscribe to our YouTube channel to stay on top of the latest Canadian tax tips. Until next time, happy Canadian real estate investing!